What analysts are saying about Wall Street 2024 outlook. Stock climbed last week with the S&P 500 rising 0.8% to close at 4,594.63. The index is now up 19.7% year to date, up 28.4% from its October 12, 2022 closing low of 3,577.03 and down 4.2% from its January 3, 2022 record closing high of 4,796.56. It's that time of the year when Wall Street stock strategists tell clients where to see the stock market heading in the year ahead. Now, typically the average forecast for the group predicts the S&P 500 climbing by about 10%, which is in line with historical averages. This year, strategists are offering a pretty wide range of views. Some see weaknesses while some see strength. The target range from 4,200 to 5,500. This implies returns between negative 8.5% and plus 19% from Friday's close. For what it's worth, the forecasts aren't as skewed to the downside as they were last year. Now, before we move on, I'll caution against putting too much weight into one-year targets. It's extremely difficult to predict short-term moves in the market with any accuracy. Few on Wall Street have ever been able to do this successfully. I do, however, think the research, analysis, and commentary behind this forecast can be very informative. Now, that said, here's what's driving Wall Street's view of for 2024. The economists that this stock market forecast work with are split on whether the U.S. economy will go into recession sometime during the year, which has implications for revenue among other things. Those who are expecting continued expansion expect growth to be modest, and those looking for a recession expect any downturn to be brief and shallow. Interestingly, most strategists still expect S&P 500 earnings to grow in 2024 despite lackluster GDP growth forecasts. This may have to do with the expectation that consumer spending shifts back towards goods from services, and in fact that the S&P has a greater exposure to the goods sector, whereas the US GDP has great exposure to the services sector. Analysts expect record earnings in 2024. Thanks to improved operating efficiencies, many but not all strategists expect profit margins to stay high, which could help amplify earnings growth even with modest revenue growth. Profit margins have been holding up, while most S&P 500 companies have low interest rate on their debt, locked in for years actually. More and more firms will still have to refinance at market rates, which continues to hover at their highest levels in years. Higher interest rate expense is a headwind for earnings growth. Thanks to refinance activity, when rates were low, the interest large companies are paying remained low. Most strategists agree that the worst of the inflation crisis is behind us. This means that should economic conditions deteriorate significantly, the Federal Reserve may once again find itself loosening financial conditions with interest rate cuts. While the economic downturn would be unwelcome, it's nevertheless good news that the Fed seems to have room to stimulate the economy. Strategists are also split on whether valuations are reasonable or whether they are a bit rich. This debate won't go away anytime soon, as valuations have historically signaled very little about short-term market moves. While most strategists agree that the valuations are elevated, not all believe that will prevent prices from going higher. Now, on valuations, at least one strategist argued that excitement for the artificial intelligence technologies could persist into the new year, and the market could be in the early stages of a bubble. The 2024 S&P 500 price target below is a roundup of 12 of this 2024 forecast for the S&P 500, including highlights from the strategist commentary. The first analyst is JP Morgan, 4,200 with an EPS of $225 as of November 29. With a step down in economic growth next year, U.S. growth to slow to 0.7% year over year by fourth quarter 2024 from 2.8% fourth quarter 2023, eroding household excess savings and liquidity and tightening credit. We see 2024 consensus hockey stick EPS growth of 11% as unrealistic. Negative corporate sentiment should be a catalyst for sharply lower estimate early next year. Now, the next analyst is Morgan Stanley, 4,500, with an EPS of $229 as of November 13. Near-term uncertainty should give way to an earnings recovery. Our 2024 EPS estimate of $229 is consistent with output from our leading earnings models, which show a recovery in growth next year, as well as our economists' expectations for growth next year. 2025 represents a strong earnings growth environment, 16%, as positive operating leverage and tech-driven productivity growth lead to margin expansion. On the valuation front, we forecast a 17.0x for the PE multiple at the end of next year. 20-year average PE is a 15.6x, currently 18.1x. The next on our list is UBS, 4,600 with an EPS of $228 as of November 8. Our 2024 target is based on the 2024 multiple of 18.5x, a 0.7x multiple point contractions applied to 2025 EPS of $249. While UBS anticipates a steep decline in yields over this period, higher equity risk premiums should offset this benefit. Wells Fargo, 4,625 with an EPS of $235 as of November 27. With volatility index low, credit spreads tight, equities rallying, and cost of capital higher volatile, it's time to downshift. Expect a volatile and ultimately flattish SPX in 2024 as the valuation limits upside and rates uncertainty elevate downside risk. Goldman Sachs, 4,700, EPS of $237 as of November 15. Our baseline assumption during the next year is the U.S. economy continues to expand at a modest pace and avoid a recession. Earnings rise with 5%, and the valuation of the equity market equals 18x, close to the current price-earnings ratio level. Our forecast falls slightly below the typical 8% return during presidential election years. Now, Societe Generale, 4,750 with an EPS of $230 as of November 20. The S&P 500 should be in buy the deep territory as a leading indicator for profits continue to improve. Yet the journey to the end of the year should be far from smooth as we expect a mild recession in the middle of the year, a credit market sell-off in the second quarter, and an ongoing quantitative tightening. Barclays, 4,800, $233 EPS as of November 28. Whether new, normal, or old, a roller coaster 2023 proved that this cycle is anything but. We expect U.S. equities to deliver single-digit returns next year as easing inflation is offset by modest economic deceleration. Bank of America, 5,000 with EPS $235 as of November 21. The equity risk premium could fall further, especially ex-tech. We see past maximum macro uncertainty. The market has absorbed significant geopolitical shocks already, and the good news is we're talking about the bad news. Macro signals are modeled, but idiosyncratic alpha increase this year. We're bullish not because we expect the Fed to cut, but because of what the Fed has accomplished. Companies have adapted as they wanted to higher rates and inflations. RBC, 5,000, EPS of $232 as of November 22. While the November rally has likely pulled forward some of 2024's gains, we remain constructive on the U.S. equity market in the year ahead. Our valuation and sentiment work are sending constructive signals, partially offset by headwinds from a sluggish economy and uncertainty around the 2024 presidential election. Our work also suggests that a greater appeal of bonds may end up being a dampener of U.S. equity market returns, but not necessarily a derailer of them. Deutsche Bank, 5,100, EPS of $250 as of November 27. Are valuations high? We don't think so. If inflation returns to 2% as economists forecast and is priced in across asset classes, while payout ratios remain elevated, fair value in our rating is 18x with a range of 16x to 20x, which they have been in for the last 2 years. If earnings growth continues to recover as we forecast, valuations will remain well supported. BMO, 5,100 with EPS $250 as of November 27. We believe U.S. stocks will attain another year of positive returns in 2024, albeit while demonstrating more sanguine, broadly distributed, and fundamentally defined performance relative to the last decade or so. In other words, normal and typical. Capital Economics, 5,500 as of December 1. Still time for the S&P 500 to party like it's 1999. It has come a long way lately, thanks both to a rise in its valuation and to an increase in expectation for future earnings. This partly reflects investors' enthusiasm about AI technology. If AI enthusiasm is inflating the bubble in the S&P 500, it's one that is still in its early stages. We think the index could therefore make further gains. Our end 2024 forecast is 5,500, approximately 20% above its current level.